Hello and welcome back to All Things Money. I'm your host, David Blain. During last segment, we were talking about student loan debt and how a third of debt belongs to subprime borrowers now. And we talked a little bit about what that means for you as either a parent or grandparent. If you missed that segment, head on over to the web, dlblain.com. We'll have a copy of the archive posted there in a week or so. You can catch up to it. But the bottom line is I'm not against college education. What I am against is spending an unrealistic amount of money in a major that either A, you can't get a job, or B, that is not going to pay a very high salary. We see that, I picked a little bit on the liberal arts in the first segment, but we'll talk about law school too. Hiring for lawyers has just plummeted, and there's the number of people graduating with law degrees that are getting degrees in law is at I think I read an all-time historic low. And so it's not just the low end, it's figuring out what the cost benefit of college is. Just like any other investment, take a look at it. I see a lot of parents and grandparents who sort of have this whatever it takes mentality, and that's just not right. You need to approach it the same way as you would go out and do any other major purchase like a house or car or something like that. Okay, enough on that. Let's move on. Another trend I've talked about a little bit, and we're going to bring it up again today. In today's low yield environment, the interest paid on a 10-year U.S. Treasury bond, the promise from the U.S. government to pay you interest is about a little, we'll just call it around 2% on a 10-year bond. So if you loan your money to the U.S. Government, the U.S. Treasury for 10 years, they promise to pay you about 2% per year. Well, for a lot of people, that seems like a very abnormally low rate, and it is. They have a hard time living on that. Maybe they're living on their interest. Now, whether that's a smart idea to try to live on interest income, that's a discussion for another day. We adopt more of a total return perspective. But what I want to focus on today is, so what have people been doing? People have been going out and they've been purchasing what are called high yield bonds, bonds that are issued by companies that are frankly close to or have the possibility of going into bankruptcy, lower rated companies. Well, they're paying a much higher rate of interest, sometimes 6, 7, 8%. We also see people moving into preferred stock. Once again, you can make 6, 7, 8%. We also see people investing in what are called master limited partnerships, oil and gas line partnerships. Once again, paying 6, 7, 8%. Now, there's nothing wrong with high yield bonds, preferred stock, or master limited partnerships. In fact, we use those to some extent at different times for different people. There's nothing wrong with those investments. But when you think that those are a substitute for high quality treasury or corporate bonds, that's where people are getting into trouble. And so we see people reaching for yield. They see these magical yield numbers of 6, 7, 8%, and they look at the Treasury note, U.S. Treasury note yielding 2%, and they jump for the higher yields. And so we see a lot of people, number one, there's a lot of risk involved in that. And number two, we see a lot of people, frankly, getting ripped off. I have a few examples here of folks. A lot of the abuses are coming in the exotic or private investments. Once again, there's a whole legitimate market of private equity, private REITs. There's a company called Stephen D. Bell and Company I think they're out of Greensboro, North Carolina, one of the largest private real estate operators in the country. Legitimate, actually make money for their clients, but you have to be an accredited investor. But there are a lot of other very unscrupulous real estate investments, private investments. We see here that in Massachusetts, the Attorney General, William Galvin, ordered LPL Financial to pay $2.5 million for improperly selling real estate bundles known as non-traded REITs. And so once again, these are things that are being sold by a lot of independent broker-dealers, and to some extent the wirehouses, but mostly some of the independent broker-dealers, where they're selling these non-traded REITs and they're going out of business. In this case, The Securities Commissioner in Arkansas has 66 open cases against complex investments. The FINRA, Financial Regulatory Industry Regulatory Authority, has a number of pending cases against these things. And brokers out there are promoting these really poor investments to unsophisticated investors that are looking for high yield investments. We see that there's an example here. A lady out in California said in 2008 the stock investments in her husband's IRA began to fall quickly, and so they moved $470,000 to a new product recommended by their broker. It was unfamiliar to them. It was part ownership in a fleet of luxury cars. Okay, she thought that the product offered what seemed a modest 7% annual rate. And she said, we knew that 12% wasn't realistic, but we thought that 7% seemed realistic. And of course, soon after they invested all of their IRA money in this, they stopped receiving interest payments. And then in 2012, the venture went bankrupt. And of course, they have a lawyer and they're suing the broker and things, but investing in a fleet of luxury cars. And the fascinating thing to me was they thought that, stocks, returns, and then the bond returns of 2%, and they just said, well, 12% is unrealistic, but 7% must be. And so they had really no basis in that. Well, we're coming up on our second break. When we come back, I want to continue talking a little bit about this chase for yield that's going on out there. So for All Things Money, I'm your host, David Blain. We'll be right back.